Something keeps appearing in comment sections across every silver channel on the internet. Every time someone posts a price target above $200, someone else calls it delusional. When a Swedish analyst named Gratty published a chart this week arguing silver could reach $500 or more, the replies were full of people laughing at him. And honestly, the reaction makes sense. $500 silver sounds like the kind of number that belongs on a clickbait thumbnail, not in a serious analysis. It sounds like a number designed to sell you a newsletter subscription or a premium signal group. So today, Shadow Finance is going to do something different. We are not going to tell you whether $500 is right or wrong. What we are going to do is walk through the actual data behind the argument, explain the reasoning with full sourcing, present the counter evidence that the $500 advocates are not showing you, and let you reach your own conclusion. One word in the comments before we start. $500 realistic or $500 insane? Tell us where you stand right now before you see what we are about to show you. Your answer at the end is the one that matters. Before any numbers, you need to understand a concept that changes how you read every piece of silver data going forward. The difference between a price story and an availability story. Gold has been in a price story for 3 years. It went from under $2,000 to over $5,000 per ounce. Extraordinary. But at every point on that journey, you could buy physical gold and take delivery. No major vault emergencies. No institutional buyers told the metal was unavailable. Gold went up because monetary policy, central bank buying, and geopolitical fear pushed the price up. That is a price story. Powerful. Real. But it is a story about money and expectations, not about gold physically disappearing. Silver is not in a price story. Silver is in an availability story. And these two things produce fundamentally different price outcomes because they operate through fundamentally different mechanisms. Here's how you can tell the difference in real time. There's a number called the lease rate. When someone needs to borrow physical silver, not a futures contract, not paper, but actual metal in hand, they pay a fee to the owner of that metal. That fee is the lease rate. When silver is plentiful, the lease rate sits near zero. Sometimes it goes slightly negative, meaning the owner actually pays you a small fee to take their silver temporarily because there is more available than the market needs. From 2019 through most of 2024, the average one-month silver lease rate was essentially zero. Analyst Carol Merks quantified it at negative 0.09%. That is the normal state. Silver is a commodity with adequate supply. You could borrow it for almost nothing because plenty existed. Now look at what happened starting late 2024 and accelerating through 2025 into 2026. The lease rate left zero and never came back. In October 2025, the one-month silver lease rate hit nearly 40% annualized, not 4%, 40. If you needed to borrow silver for 1 month in October of last year, you were paying the equivalent of 40% per year to access it. That is not a market with adequate supply. That is a market where deliverable silver is genuinely scarce and the people who need it are competing with each other for access to what little remains. Today, the lease rate has pulled back to 0.75%. That sounds small, but 0.75% is not zero. And here is the critical point. Not a single day in the past year has the 1 month silver lease rate returned to zero. Not one day. The physical stress has eased from its peak. It is not resolved. As long as the lease rate refuses to return to zero, the availability problem is still active. The market is still operating under physical strain that no amount of paper trading can fake. In a price story, paper instruments set the price. Futures, options, ETFs, synthetic instruments. These can be created in essentially unlimited quantities because they do not require physical metal to back every unit. The COMEX has historically operated at a paper to physical ratio between 5 to 1 and 10 to 1. Currently, on the May contract alone, that ratio exceeds 5.2 to 1. The institution on the other side of your buy order sells you paper silver without producing physical metal. They create supply of the instrument in ways a mine cannot create supply of the commodity. That is how round numbers become resistance levels. That is how paper absorbs buying pressure without price moving. In an availability story, this mechanism eventually fails, not through any single dramatic event, through the accumulation of physical buyers who will not accept paper substitutes. The solar manufacturer cannot tell their production line to accept a futures contract. The semiconductor fab needs the metal. When those buyers pay whatever price is required to secure actual metal and supply is genuinely constrained, paper's ability to suppress price reaches its structural limit. This is not theoretical. Nickel in March 2022. The LME nickel price spiked from $25,000 to over $100,000 per ton in approximately 2 days. Short positions could not cover with physical metal. The LME canceled trades and halted trading entirely, an intervention that would have been unimaginable 1 week before it happened. Now Gratty's chart and the $500 number. His methodology is specific. Silver's 45-year price history shows what chartists call a cup and handle formation. Left rim at the 1980 peak near $50, decades forming the base, bottoming at $350 in 1991. Right rim formed with a 2011 peak near $50 again. The breakout above that 45-year rim happened in 2025, when silver definitively cleared $50 for the first time in 44 years. The standard measured move projection has already been exceeded, which in technical terms suggests momentum stronger than the pattern's initial target. Gratty applies a standard axiom: the bigger the base, the higher in space. 45 years of base formation supporting a dramatically larger price move than a cup that formed over 2 or 3 years. His analysis converges at $500. But here's where shadow finance adds what the $500 advocates leave out. Technical patterns have base rates. Not every cup and handle produces its measured move. Across commodities and equities, the completion rate for cup and handle formations varies widely. Gratty's pattern is retrospectively identified. Thousands of potential formations across markets have formed and failed without producing the projected target. Second, $500 silver changes the economics of every industrial application that consumes it. A standard solar panel, silver content cost rises from approximately $8 to $12 at current prices to $50 to $70 at $500 silver. That fundamentally alters project economics and accelerates substitution research that is currently moving slowly because silver is still affordable. Third, the $500 thesis requires multiple conditions to align simultaneously. The May delivery confrontation must produce upward repricing. Industrial demand must remain intact through that repricing. Gold must continue its bull move, maintaining a favorable ratio. The lease rate must keep signaling physical scarcity. Each condition is individually plausible. But 4 conditions each at 60% probability compound to approximately 13% probability. Not impossible, but significantly less certain than a sequential checklist presentation makes it feel. Fourth, lease rate spikes can reflect factors beyond pure scarcity. Settlement mechanics in specific delivery windows, temporary logistical disruptions, sanctions-driven access constraints, and speculative positioning can all elevate lease rates independently of physical shortage. The October 40% spikes likely reflected genuine scarcity. Whether the current 0.75% reflects ongoing scarcity or a normalized but elevated settlement and friction is a genuinely open question. These counterpoints do not invalidate the $500 thesis, they contextualize it. The difference between those two things is the difference between analysis and advocacy. Where does this leave the data right now? Silver at $85, COMEX registered at 78.6 million ounces. May open interest at 384 million ounces of paper obligation against that registered pool. Shanghai premium near 15%, lease rate at 0.75%, which is not zero. Gold to silver ratio at 59.6 to 1, still above the historical average of 40 to 50. Run 2 simple arithmetic scenarios. If the gold to silver ratio compresses to 50 to 1 with gold at $5,000, silver reaches 100. If gold continues its third bull move to $8,000 and the ratio compresses to 40 to 1, silver reaches $200. Those are not Gratty level projections. Those are multiplication outcomes of 2 variables that both currently carry directional momentum in silver's favor. The medium-term question is whether the May delivery math forces a repricing. The long-term question is whether the availability story that the lease rate has been documenting for over a year eventually expresses itself in price the way physical scarcity in every commodity market eventually does. Here is the honest version of the $500 argument. It is not a promise. It is not a guarantee. It is a description of what the physical market is communicating when you read the data without assuming the paper price is always correct. The floor for silver's long-term price is likely significantly above $85. The ceiling is higher than most people currently believe is credible. The probability of reaching $500 specifically is lower than the advocates present and higher than the skeptics admit. The lease rate chart is the single most important piece of evidence in this entire conversation. It has not returned to zero in over a year. That means the availability problem is still active. Everything else, the vault drain, the Shanghai premium, the technical breakout, orbits around that single fact. One word in the comments. We asked at the start, $500 realistic or $500 insane? Now that you have seen both sides of the data, has your answer changed? That single word tells us whether the evidence landed. And if you are watching Shadow Finance for the first time, subscribe. What we do here is put sourced data and genuine counter evidence in front of people who deserve to see both sides of the argument they are making decisions with. Verify every number, check the COMEX vault reports, pull the lease rate data, read Gratty's chart yourself. That is the standard. This is Shadow Finance. We will see you in the next one.